Hello and welcome to the Business Standard Morning Show. I'm Thirumoy Banerjee and here's a look at the stories for the day. It has been 2 months since Hindenburg Research published a scathing report on the Adani Group. Since then, the group has lost over 7 trillion rupees in market cap or MCAP. However, it has also taken steps to regain investor confidence. In our first report, Nikita Vashisht and Puneet Wadhwa explored the group's journey in these 2 months and what needs to be done to get the group back on track. Also, is the worst over for the group stocks? 2 months ago, US-based short seller Hindenburg Research released a scathing report against the Adani Group. Gautam Adani, who was the world's fourth richest man back then, was accused of running an empire that engaged in brazen stock manipulation, accounting fraud, and improper use of offshore tax havens. The research firm also warned investors against the group's high debt and overvaluation to the extent of 85% in some group stocks, and the stocks plunged. The counter of Adani's flagship company, Adani Enterprises, tumbled from around Rs 3,400 to nearly Rs 1,017 in a matter of days. Gautam Adani has lost nearly 3,000 crore rupees a week in wealth, suggests an M3M Hurun India Rich List report. The accusations, however, have been denied by the conglomerate. Meanwhile, the group has taken several measures to regain investors' trust since then. Some of these include full prepayment and repayment of immediate share-backed finances, issuing clarification on the role of Vinod Adani, the elder brother of Gautam Adani, and reducing promoters' stake by bringing Australia-based GQG partners on board. It also put some capex projects on hold. But have the steps yielded results that the group wished for? And is the worst over for the group?
Initially, they have ring-fenced the promoter group from any kind of financial mishap that could happen, right? So having strengthened their own position, they have ensured that they have regained institutional confidence and to a large extent shareholder confidence by repaying back their uh, debt in their personal capacity as promoter group. They just did a kind of an introspection. They realized that they do 50,000 crores plus of EBITDA every year, which is good enough to fund their existing uh, debt, interest payments, and also lead to completion of the existing projects. So what the company is doing is that the projects which they have taken on, they are completing. Okay, they're consolidating, and if they continue in this state for let us say for the next possibly 8 quarters, their balance sheet is going to look extremely strong.
At the bosses, the steps have stemmed the shares' free fall, at least for now. From their recent lows, the stocks have bounced back in the range of 2 to over 100%. However, there could be further downside if the uncertainty persists.
I think the stock market, as far as the prices are concerned, I don't think anybody can argue that they're still very cheap. But I think quite a lot of excess fat has burnt off. So therefore, I think there is some stability as far as the stock market pricing is concerned. There could be certain further downside. But if you really see the new ones that they have bought, which is cement, that they bought very recently. So therefore, and there are very good comparables for that. So therefore, I don't think there is too much of a downside to the cement business because there are others which are probably as well valued or even better valued. So therefore, that's a very good business, very good cash flow business. So I think that I think has reached probably its level. The other stocks, there is one could argue that there is further sort of valuation correction possible.
Going ahead, analysts say Gautam Adani needs to shore up equity capital, remain in growth neutral mode to sustain cash flows, and raise funds via divestment. The report, analysts said, has pushed the once aggressive Adani Group into a consolidation phase. With concerns still looming, the stocks may not guarantee excessive returns for investors in the near term. Today, global developments and fund rotation ahead of the closure of the financial year will sway the markets. After COVID, there has been a spike in demand for air travel in India in both the domestic and international markets. But at the same time, Indian airlines are not able to level up the capacity for the surging demand. Airlines are facing a shortage of both aircraft and crew, and more than 100 aircraft of airline companies remain grounded. So, why is a significant number of Indian aircraft remaining grounded? And how is it taking a toll on the Indian aviation? Tariq Ahmed brings you the answer.
Surprisingly and shockingly, the situation has turned the other way. Where at one point we did not have passengers to fill our airplanes due to COVID, now we do not have enough airplanes to fly our passengers.
That was Civil Aviation Minister Jyotiraditya Scindia pointing at the fact that Indian aviation industry is unable to keep up with the increased demand for air travel in the country.
The number of passengers in the last 6 years has almost doubled again from 60 million to 140 million. A CAGR of almost 14.5%.
And these numbers are set to increase as the country moves towards becoming a $20 trillion economy by 2047. At the recent aviation summit, CAPA stated that international and domestic air traffic is expected to grow at 20% in FY24. Meanwhile, Indian airlines are facing a shortage of aircraft and crew. For instance, Air India had to cancel 6 of its weekly services from India to the US due to a crew crunch for its wide-body aircraft. At the same time, more than 100 aircraft, or 15% of the total aircraft of Indian Airlines, remain grounded due to a lack of maintenance, repair, and overhaul facilities in the country. The supply chain constraints and increased shipping charges for the aircraft's engines, frames, and other parts are some of the contributing factors for the aircraft to remain grounded.
The reasons that the aircraft are getting grounded, and purely as a result of what we've seen so far, is and has been because of engine reliability issues and damage or metal cracks occurring in brand new engines in operation. Most of the engines that are in commercial deployment in India are Pratt and Whitney, and these engines should not have a metrology or a metal damage, especially when it's a brand new engine. So clearly, there is something wrong that Pratt and Whitney needs to address. And on this, it is imperative that the government and the regulator also step in, because this has got nothing to do with supply chain. It has to do with the engines failing, and this is something which is a major concern.
The aircraft and crew shortage is hampering the growth of the Indian aviation industry. The Directorate General of Civil Aviation has approved 22,907 domestic departures per week for the coming summer. But the number is 9.5% less than that of the previous summer.
Having these aircraft grounded is a challenge because it directly impacts your revenue. On the cost side, the challenge that you face is a lot of low-cost carriers, and including some of the full-service carriers too, enter into long-term agreements with engine manufacturers, maintenance providers, and other service providers. And in a lot of these contracts, there is sometimes a challenge because there is a minimum guarantee. So you negotiate a rate, you negotiate a very hard rate, but that negotiation comes with certain terms and conditions in terms of whether you talk about minimum guarantee, that it will at least do this many number of hours. So then that is when it starts hurting, because there are certain costs you can control, certain costs you can't. I mean, if all of a sudden you have, within a span of 3 or 4 months, you have 20 aircraft grounded, the challenge for you is you've already hired the pilots and the cabin crew for them, because those aircraft are flying. So now you suddenly have these pilots and cabin crew which you have, but you don't have the aircraft that is there for operation.
However, at the CAPA Aviation Summit last week, the Minister of Civil Aviation mentioned that the ministry had extended the wet lease program for airlines from the earlier 6-month period to 1 year. The aviation industry is also focusing on recruitments and investing in capacity building at airports. Grounded aircraft are a liability and loss of income for airlines. When the Indian aviation industry is experiencing increased demand for air travel, grounded aircraft mean underutilization of existing resources. While Indian airlines are already spending big bucks on the expansion of fleets, bringing the grounded aircraft back into service remains crucial in the short term.
From the difficult times being faced by the aviation sector, we now talk about the inflation scourge that has hit the Indian economy. Core inflation has remained sticky in India. The latest inflation figure of 6.44% in February was above the Reserve Bank of India's or the RBI's upper tolerance limit. Recovery after the pandemic has been K-shaped, and a high inflation rate may further exacerbate it. So, overall, what has been the impact of inflation on the Indian economy? Tushar Verma explains.
Inflation continues to remain high in India. The February figure of 6.44%, a decline from 6.52% in January, was only a marginal relief. An indicator of the impact of inflation was the massive fall in household savings during the first half of FY23. Savings were reported to be 4% of gross domestic product or GDP, which was a decline from 7.3% in FY22. It is worth noting that in the last 14 months, inflation has remained above RBI's upper tolerance level for 12 months. This is further exacerbated by the fact that experts have continued to point out that India is undergoing a K-shaped recovery. Improvement in consumer sentiment has been mixed. While the improvement in urban areas was 15.2%, it was only 7.6% in rural India. So, what do experts have to say about the impact of inflation on this rural-urban divide?
Inflation does have an impact in terms of the lower income groups more than the higher income groups. Now, it's not just rural urban. Even in urban, you have lower income groups that are feeling the pinch. And clearly, one of the big impacts of inflation has been whether it's food price inflation, fuel price inflation, input prices which are going up. So we find that consumers are trading down on the products they buy. There is the discretionary income which is used for buying buying sort of non-essential products are diverted back to buying essential products.
Over time, as the economy started opening up, I think we are seeing urban areas doing well as far as incomes are concerned. I think and the labor force participation survey also shows that 60% of the jobs in the urban areas are in services. So clearly, I think urban area is benefiting from this. Now, as far as the rural economy is concerned, I think it's relatively worse off compared to urban areas, but they have some drivers. For instance, I think the rural wage growth has been picking up. It was earlier trailing the inflation rate, so it was negative. Now, I think the rural wage growth has become positive, both for agriculture and non-agriculture wages.
The growth in private final consumption expenditure has been on a decline as well. From 20% growth in the first quarter of FY23, it has nosedived to a mere 2.1% in the third quarter. This reflects a slump in demand and perhaps fizzling out of pent-up demand which had fueled the post-pandemic recovery. So, what do experts have to say about the impact of inflation on consumption?
The sense is that there is a revival in the consumption even in lower income groups. I won't say urban rural again because I think even in urban cities we have low income groups. So I think there is a recovery which we are seeing, which hopefully with a lot of the projects, a lot of the large sort of capex project that the government has initiated, a lot of that money should start to percolate downwards into the lower income groups as well. And I think we should start to see some of the K-shaped recovery getting sort of, becoming more and more a U-shaped recovery with consumption reviving in the lower income groups.
As far as the consumption is concerned, what we were seeing earlier is that goods consumption was strong. Now the services consumption is strong. And that pattern, I think, will continue. It's true, inflation eats into the purchasing power of people and hits the poorer categories more. Overall, I would say that the K-shaped recovery will continue. and because the corporate wages are going to go up much faster.
Chief Economic Advisor V. Ananta Nageshwaran had said recently that inflation will fall in the coming months. He supported his argument with decreasing food and international commodity prices. However, so far, the inflation rate has been above RBI's tolerance level. So, how do experts think inflation will turn out to be in FY24?
Well, I think we expect inflation to come down to 5%. I think that is under a very critical assumption that monsoons will be normal. See, the crude prices have already come down and they will filter through to the economy at some point. So the fuel inflation, which was in double digits, will come down. Core inflation is sticky, but with the demand slowing next year, I think core inflation should also come down to about 5.5%. That's our estimates for 23-24. As far as the food is concerned, I think a lot depends on how monsoons play out. Remember that this is going to be an El Nino year, and there could be scanty rain.
Experts are divided as to how inflation will pan out. While some hope the K-shaped recovery will turn U-shaped, others fear that the K-shaped recovery will continue. There is a sigh of relief on the hope that the Indian economy is better positioned to deal with negative headwinds than other countries. But how inflation will exactly move going forward into FY24 remains to be seen.
Several listed stocks in the market often witness expiry of their lock-in periods, which significantly drives their prices in either direction. So, what is a lock-in period and how does it influence a share? Harshita Singh decodes it for you.
A 3-year lock-in period recently expired for Yes Bank shares. The stock witnessed wild swings that day, but has stabilized since then. The lock-in period for Yes Bank, where investors were not permitted to redeem or cash out of their investments, was part of a bailout plan chalked out by the Reserve Bank of India and the Securities and Exchange Board of India. Though typically a lock-in period in the stock markets is used for new share offerings, they are also applicable across various financial instruments like mutual funds, insurance policies, and bank deposits. So what does a lock-in period for initial public offering mean and why is it enforced? A lock-in period acts as a temporary restriction on the sale or transfer of shares after an IPO. This is meant to prevent company insiders, including promoters, employees, and other stakeholders like anchor or pre-IPO investors, from selling their holdings immediately after the stock's listing. The idea is to provide stability and security to the share price, which may otherwise grapple with severe volatility in the early stages of public trading. This also allows the company to establish itself in the market and gain the confidence of long-term investors. The length of a lock-in period post an IPO varies for different sets of stakeholders. For instance, 50% of the portion allocated to anchor investors, which constitute marquee institutional investors, is required to be locked in for 30 days, while the other half has a lock-in period of 90 days. In the case of promoters, the lock-in window post an IPO varies between 6 months and 3 years, depending on certain conditions. Once the lock-in period or selling freeze expires, investors are allowed to exit the shares. In most cases, selling by large investors following the lock-in expiry weakens the stock price in the market as its supply increases. At the same time, the market sentiment towards the stock also turns relatively bearish due to major investors dumping the shares instead of holding them. Hence, lock-in period expiry is often seen as a test of the investor sentiment for a given company. For instance, shares of new age IPOs like Paytm, Nykaa, and Zomato, among others, which were already beaten down last year on recession and valuation worries, succumbed to even more pressure towards the year's end. This is because several large investors exited these stocks post the expiry of their lock-in periods. Hence, retail investors are often vulnerable as they can only grasp institutional investors' assessment of a company's long-term growth prospects after the lock-in period ends. Large institutional exits following lock-in expiry often make small investors lose confidence in the stock. After the lock-in period expires, an investor who is optimistic on the company can buy more shares amid weakness triggered by large selling.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Shares of Yes Bank had tanked 13% to hit an 8-month low of Rs 14.4 on the BSE on March 13 during intraday trade after its lock-in period of 3 years had expired. That's all for today. For more news and analysis, please log on to business-standard.com.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.